Good morning, everybody. We want to welcome you to this installment of the Louisiana Restaurant Association's How To University, the 2021 financial series, sponsored by Patrick Grow CPA, a public accounting firm. This is another in a series designed to help restaurateurs expand and evolve their knowledge of key areas of successful restaurant management. I'm Stan Harris with the LRA, and today it's my pleasure to welcome back with us Patrick Grow CPA, who works with more than 50 restaurant groups. And Patrick has over 25 years as a CPA working with some notable businesses and many notable restaurants in Louisiana, and is also an investor in restaurants. Patrick will be joined by his client and LRA member, Brian Landry, co-founder and chef of QED Hospitality, which operates Jack Rose Restaurant, Hot 10, Bayou Bar, and the Silver Whistle Cafe, all located in the Pontchartrain Hotel on St. Charles Avenue here in New Orleans. Together, they're going to help you gain a better understanding of cash flow for your recovery and beyond. Patrick and Brian have worked together for a number of years, and Patrick suggested Brian to join him to provide the operator perspective because, as Patrick said, Brian really gets it. Today, they're here to help us all learn to get it a little bit. And the one thing I think we can all agree on is that the professional, profitable, and successful restaurant operators and hospitality businesses, the one thing they all do is they know their cost structure. So understanding a little bit about your cost, your profitability, where your cash flow comes from, and possibly, as we mentioned a bit earlier, your break-even analysis. We used to do it with our restaurant operators, and it was always a great exercise until one of them said the voila moment that it only took him 33 days to break even on his analysis. When I explained that we didn't have any months with 33 days and February was going to look tough, he finally got it. So without further ado, Patrick's going to kick us off by explaining to us what is restaurant cash flow. Patrick, welcome.
Thank you, Stan. Thank you. Welcome, everyone, and happy pre-Easter and Easter weekend. So basically, Brian and I want to go through today with you guys the cash flow, which is as critical or even more critical than when you're looking at your P&L statement for costs, which we're not going to really cover. We're not going to cover today, but obviously that's a critical part of cash flow is managing your costs to have profit to be able to factor in for cash flow. The thing that a lot of restaurateurs need to understand is that cash flow represents not just the net effect of your operations from a P&L perspective, but it also has to consider any kind of debt service you have, any kind of fixed assets you have, and any other obligations the restaurant has where cash will go out of the door but not be considered expense. The other thing that a restaurant needs to really understand and realize is that we all know that restaurants have different time periods where we have better cash flow than others, which Brian's going to cover in another slide. But consideration needs to be made that when those profits are being made, money needs to be reserved to be able to fund the times when we do have decreases in sales, because as we all know, anything can happen at all that could decrease revenue or even eliminate it. So with that, Brian's going to go on and talk about budgeting our cash flow.
Hello, everyone. Thank you for having me this morning. So I think, getting a feel for your bank account, for your cash flow, is a lot like getting a feel for many other things, many other aspects of your business. So, one of the things we look at is on a weekly or bi-weekly or monthly basis, what typically happens to your bank account, depending on when you're paying your bills, when your payroll is, when rent is due. All of those things greatly affect your cash flow. So, I've been working with Patrick for quite a number of years now, and one of the things that we notice is there's a rhythm to the cash that flows in and out of the business. And so we look at it through the lens of what do we need for the next 2 weeks? What do we need for the next month? What do we need for the next quarter? We also look at it throughout the lens of the whole year. So I think getting in touch with the rhythm of how the cash flows through your business leads to a greater amount of success.
So the timing of that is just as important as anything else. When it hits during the week, when the month, and how it may draw down your available cash.
Exactly. And one of the things that greatly affects that rhythm is kind of the terms that you are on with the majority of your vendors. You know, if you're on a biweekly payroll, when you pay your vendors is also critical to managing your cash. So if you're on COD, for example, as every product hits your back door, you have to have that cash on hand in order to receive goods you need to sell. We prefer to go on like a net 14 with a majority of our vendors because it keeps us accountable in a 2-week rhythm for when we are paying for those goods. One of the things I've worked with Patrick on, which he'll get into in a second, is a lot of vendors do offer net 30, so that you're only paying those vendors on a monthly basis. But really, in order to do that, you have to keep a pretty enormous amount of cash on hand when you allow that many bills to stack up over the course of a month. So we prefer to work in kind of like a bi-weekly rhythm with when we are paying our bills, because it allows us to stay highly attuned to what is taking place in the bank account over the course of the month.
You look at more, this is 26 separate little 2-week periods when you're going through that year to keep your operating discipline and manage that cash flow.
Exactly. And I think Patrick was going to talk a little bit about the I guess the positive effects of why we would break down cash into those 26 2-week periods.
Patrick, you're muted. I bet we all get to say that a bunch, or we get to hear it.
Okay, how's that?
There you go.
That's perfect.
Okay. Can everybody hear me okay?
We can hear you crystal clear. Thank you.
Good. Okay. So, in the way I help clients manage cash flow, we literally live between 3 things: rent, sales tax, and payroll. Payroll typically is every 2 weeks. So when we budget out, we're budgeting out a week to 2 weeks in advance, depending on how tight the money is on a restaurant. Even if a restaurant's cash flowing well, we still budget out every 2 weeks because we know we're going to have payroll, which is the big hit, sales tax on the 20th, and rent on the 1st. And so even with my own restaurant, I do that. When I go through payables and I look at when we cut checks and when the money's coming in, that's exactly what I do. I cash flow. That's how I work my cash flow. And that's how I do it when I handle it and work with clients on it also. Very few vendors, especially right now, are going to offer net 30 days. But I wouldn't recommend that, because unless you have a tremendous amount of cash flow or you have a really big cushion, if there's any kind of drop in sales toward the end of that 30-day time period and you owe vendors invoices for 3 weeks, you could potentially be in a bond. Some people like COD. They write the checks every week whenever they receive the invoices. Most people, when I get a client and I start working with them, we request the vendor to give us 14 days. And basically we cut checks every single week. And most of the regular food vendors get paid weekly, but we have that 14-day lag time to get the checks to them, to process, and to budget out for the next 2 weeks. A big day to release checks for restaurants that are tight on money is on Thursday or Friday, because we know the checks won't clear until the beginning of next week. And we typically, and I don't want to jump ahead on the slides. I think I'm on the right one here, but the 60% usually of sales in a restaurant will come in on Friday, Saturday, and Sunday, or Thursday, Friday, and Saturday and Sunday. And so you have a tremendous amount of cash coming in. And let me put it to you this way. On Monday morning, I check a whole bunch of bank accounts to see how they look. So that's more the process that I look at to budget between those critical big expenses. Other than that, your food costs, your utilities, things like that are small. Your cost of goods sold invoices should come in fairly regularly, weekly. And unless you have a big spike in business or you increase inventory for some reason, those should not fluctuate that much. And again, unless sales are up, which is a good thing. You want to make sure that your credit cards are batching every night. Some people don't check that. The way we do the accounting, we look for that each week when we book the daily sales reports. And sometimes batches get hung up. Sometimes they don't come through. That could obviously affect your cash flow significantly if you don't get your credit card payments. So the next slide.
Well, Patrick, you mind if I say something real quick on that?
Go right ahead. Let's be interactive for sure.
One of the interesting things about the world moving to credit card payments is that even if you're batching your credit cards every night, a lot of that weekend money doesn't actually hit your bank account until Monday or Tuesday. So again, if we're paying attention to the rhythm of the bank account, during the first half of the week, you're kind of paying everything off as those checks begin to clear. And then you get a windfall of money back into the account once all of the weekend sales and the credit card sales clear and then end up in your bank account on Monday or Tuesday. So again, as long as you pay attention to the rhythm of what is taking place in the bank account, when your credit card sales hit your account and when you're cutting those checks, it gives you just a much better feel of what you should be looking for in the future.
And let me add one more thing, Stan. One of the big mistakes that I cannot even tell you how many times I've dealt with over the past 18 years is that restaurants have a difficulty managing their cash flow. They're not managing their cash flow. When they come to me, they've already started using their sales tax money they collected or payroll tax money they collected to pay their bills. That is a snowball that will destroy a restaurant, and sometimes you'll never catch up.
Well, it's interesting you mentioned that. We get calls during the summertime when it's really slow for restaurants about somebody needing some assistance with cash flow, or they want to find an investor or find somebody that can help them. And I always ask the question, how are you on sales tax? How are you on payroll taxes, or using a payroll service? That always helps you, because those are really the slippery slopes when it comes to cash flow. And the other part too is when you have these windfalls that come to you, whether it's PPP money or whether it's hopefully the Restaurant Revitalization Fund grants that come to you, you need to look at what the intended purpose of that is. And, you may have a short-term window, but that's probably not a time to do massive capital improvements unless it's forgivable under these programs, and looking at what those things allow. And they're pretty robust as to what is covered in those areas, but managing cash flow is really critical. And I love what you're saying, Brian. Timing at times, this is not a heavy working capital business. It's a business that requires working capital, but typically we're not operating in that type of environment because it's not a normal manufacturing cycle where the order's taken and then the raw materials are purchased and then you fulfill it and then you sell it and you collect the money, or you have some credit facility. We're doing this sometimes on the same day basis. The food comes in, we prepare it, we sell it, out it goes, we collect a credit card or the payment, and then we've got to wait for that to clear the transaction. So all those things really are creating stress in that transaction environment.
Yes, sir. So creating a budget, in my opinion, is very key. It doesn't have to be a very detailed budget. Detailed budgets are better. But even if you do a high level projection of what you think your sales are, whenever I'm working with a restaurant that's tight on money, and that's almost at any given time in my life, somebody's tight on money. Okay, somebody is, and what I do is I basically budget in my mind when the client doesn't have a budget. I budget out usually 2 to 4 weeks out. And that's when I'm helping them to manage the cash flow. So I'll look at, okay, today's Thursday. Okay, we have to do a check run today. We're estimating sales will be between now and next Thursday, $25,000. We have X amount of payables we have to pay. Well, if payroll is next Friday, that makes a big difference. If payroll is tomorrow, I factor in the payroll if it comes out on Friday, and then I figure out, okay, so now we have our cash available minus our payroll. This is what we have left to pay. We already paid sales tax earlier in the week, and we have 2 weeks out now to build cash. Just what we mentioned earlier, and what Brian said about the flow of the money. So I know that if we do a check run right now, we're going to have a whole 2 weeks to build up cash for the next payroll, but rent's due today. So hopefully by now we've already cut the rent. So now we have the rent and the sales tax out of the way, and we pay in payroll tomorrow. We're in a really good situation if we have any money. We're rolling along.
Yeah, and I'll remind people in a lot of cases on those leases that, rent's due on the 1st. It's not like an apartment where you pay it on the 5th, 6th, or 7th. It's when it's due on the 1st, it means it needs to be in their hand on the 1st. So it means that you may be paying a little bit early. But, one of my favorite old country songs was "There's too much month at the end of the money." So you want to make sure that you don't run through it.
Right. And to your point, Stan, when people right now are getting PPP loans, are they going to get restaurant money? Which I think Brian and I will talk about that later. That's a whole nother process to handle. That's definitely a whole nother process, because some people are getting more money than they've ever had in their bank accounts in their lives.
Right. And the other part too, when you're looking at this budgeting piece of this is just about operating discipline. If you can create it, to your point, down to the dollar is great, but a high level, at least you have some targets and you know what you're working against, so that you have something to compare and measure to every day.
And typically, if you're going to hit like what we have listed here for the budget for cost of goods sold, if you know you're going to hit your benchmark percentages, you can estimate your sales and use the percentages for cost of goods sold and labor. You know what your rent is, you have an estimate of utilities, you know what your insurance payment is, and then the rest is basically a general, I would call it a plug for the general overhead costs.
Sure. Yeah, you've got your fixed costs are fixed. It's the variable cost that you've got to track and make sure you stay on top of as well.
Right. That's a whole nother seminar that we need to do.
Absolutely.
That's a job in itself.
Absolutely.
I think when it comes to creating a budget, even the thought process can sometimes feel a little overwhelming. Like how am I actually going to write an accurate budget for the next 12 months? But I think even in that process, when you take the time to sit down and plan it out, we know typically in New Orleans, every spring, we're going to get pretty cash flush. We're going to have from Mardi Gras all the way to June, we're going to have some really great sales months in the spring every year. And then in summer, when the entire city goes on vacation and there's no conventions, those are going to be really lean months. So a lot of that cash that we're taking into our bank accounts in the spring, we're actually going to rely on that cash to help us make it through summer. And then we're going to get into fall and we're going to get pretty cash flush again. And the rhythm to the bank account, it's the same year after year after year. And, of course, there's like major events, both positive and negative, whether it could be a flood, in the fall, or a hurricane or things like that. But the rhythm to tracking your cash and knowing that if you correctly budgeted, you know what months the bank account should be growing, and you know what months the bank account is going to deplete, what you're prepared for.
Right. If we can slide on, there we go. And that's what we're talking about right now, is just managing that cash, understanding, that those times you're going to have those peaks and valleys, especially in a more seasonal market like New Orleans. So you're talking about running lean and mean, right?
We are, and I think we've all learned to do that, especially over the last year with COVID. And a lot of the skill to running lean and mean and making sure that the bank account does stay in the positive gets really into how the specifics of managing your own business. A lot of businesses, including my own, have run with much smaller menus in the last 12 months, which has led to less inventory, less money in the walk-in cooler, less money sitting on the shelves, not so much alcohol as backup. And so, running lean and mean, especially during the times of COVID, has meant that in a lot of cases, we have managed cash on a daily to weekly basis, and that we needed this week's sales to help pay for next week's sales. So as we really trimmed a lot of the fat, not that there's ever much in a restaurant, but as we've learned to even run leaner and meaner than we have in the past, with less people in the kitchen, with less people on the floor, with less stuff on our shelves, that is one of the most meaningful ways to hold on to some of your money. And as we come out of COVID, and as we get back to regular sales, 2019 numbers, things like that, I think a lot of the lessons we've learned over the last 12 months, just because we had massive menus in 2019, now's not the time necessarily to go back to having so much inventory or running with extra large menus. I think part of the recovery will be, let's run just as lean and mean in the next 6 to 12 months as we have been, and that'll help us kind of build the coffers back up.
Yeah, you want to have that discipline in putting that together. What we've seen doing this, we've helped quite a few members get a special permit so that they could sell down wine inventory. And I'm doubtful that they're going to build back $1 million wine inventory, because what you're seeing is that it's not necessary to operate your business on an efficient basis. And inventory, as I explained to people, when they look in your walk-in cooler, as you mentioned, or you look at the wine rack or the wine storage area, that's cash. That's cash that's sitting there. Unless you're turning that over to keep your cash flow robust on that inventory, you really can't afford to let it sit there. I used to look at my restaurants and distilled spirits, things like that. Beer, we used to turn 40 to 50 times a year. Cocktail, all the distilled spirit stuff, we would turn that 15 to 18 times a year, and our wine at least 12 to 15 times a year, because if we're not turning it over, that cash is just sitting there and we're not making any money on it. So even at a time where we, might take a little less margin to move it out of there, if I can turn a $50 bottle of wine into cash, it's a whole lot better than sitting on the shelf.
And Stan, let me add one thing too. I can say that I'm very proud of all the clients that I worked for over the past year, because a lot of them had they were making really good money, but they had a lot of fat in their overhead. They had a lot of overhead that really didn't need to be there. And we're always working on cutting it down and addressing it and when COVID hit, it was a necessity. It wasn't an option, and it had to happen.
And it becomes menu and operating discipline.
Yeah, I mean, it did happen. They did a really good job on it. And so now when we're building sales up, just like Brian said, I mean, I've told him our net percentages can be even higher than they were before, because if they continue to not get fat and happy and just keep running on board and run lean, we will have a tremendous next 12 to 18 months.
And what we struggle for in the restaurant business is getting that rainy day money, right? We always decide there's something that we want instead of not necessarily something we need. We need to make sure our facility's safe and clean and the equipment's working and we have the right tools and the rest of those things. But we've got to stay on top of managing, because inevitably those emergencies are going to come. That water heater is going to go out. the booster heater is going to go down, the ice machine's going to need a new compressor, or if you're taking care on a triple net basis, your HVAC system goes out, you're stuck.
Yeah, and all of those things typically happen in the summer when we don't have any cash around anyway.
Yeah, that's a fact. The air conditioner doesn't break in the winter time, does it?
It sure doesn't. Yeah, and so I think that speaks again to why being in touch with the rhythm of your bank account means something. Because when we are in those great months, that doesn't mean let me put it in my back pocket and take it home with me, because things do break. We do seem to have some sort of natural disaster every couple of weeks lately.
Or an unnatural disaster.
So, making sure that when we are cash flush, that doesn't mean we're just running out to spend it, because we are going to rely on that cash for all of the things that pop up throughout the year that are just unexpected.
Yes.
So the one part that we did in operating our business was trying to explain to my partner for many, many years early on that if we paid ourselves a little bit of money so that we covered our basic expenses, then we would be part of that budgeting process and have that discipline. And we took a lot of our personal expenses out of our business. And especially all of a sudden we woke up and our net profit margin went up 7, 8, 10, 12 points. And we created more value in our business. And we took some of the pressure on cash flow management out, because we didn't have these swings to take care of personal needs. So this is a great question on how do you pay yourself?
So what I usually recommend people, Stan, is that you set, and I've made changes to payroll to my clients that they didn't necessarily like, but they respected it and liked it later. And with that being said, I mean, I had a client that I started working for about 8 years ago. Both him and his partner were on huge salaries. And when you look, they never stopped to look at the profits they were making. Their salaries themselves exceeded the profits they were making. So they were creating themselves to run negative. They were overdrawing the bank account. They ended up hitting a line of credit and drawing 100,000 on the line of credit. And then he hired me to start working for him. And I started putting the books together. And then I saw what I just told you. And then I went in and said, okay, guys, you're not going to like what I'm going to tell you, but we got to cut your pay. And it's, what do you mean? And I said, well, you're taking too much money. Look, you're taking 350,000. You're only making 300. So before your salary. So what we did then is we set a moderate salary, just like you said, that people could live on. And part of that has to do with people's personal budgets. That's a whole nother story. But what we did though, is we said, okay, we're going to have a moderate salary. And then what we do is when we build up cash and we make those profits, we'll pay distributions when they happen. That works well with what Brian's saying about how you now are not just on a $250,000 salary and you sweat it through the summer because of your own pay. I mean, you don't want to put undue pressure on you.
You created undue pressure on yourself for no reason.
Right. So then, but then when you make the money and you have a budget through the slow season of the next year to know you're reserving enough cash, well, then you pay distributions to your partners.
And when you take that distribution out, you have to remember your other hidden partner, who's Uncle Sam.
Right.
So about 40 plus cents of every dollar, when I took a distribution, always went to an account that either me nor my wife could access, because I knew every quarter we were going to be making that payment to our good friend, the uncle.
Yes, that is a whole nother thing that could be a whole nother session too.
All right. So paying yourself, it makes sense to
Oh,
do
but
it on
one
a
other thing
level
too.
basis.
The other thing people have to realize is that you have to consider and control your personal budget. So a lot of times when I work with a client in their business, I end up getting involved with their personal budget.
Absolutely.
Because they say, well, I need $18,000 a month to live. And I said, well, we got a problem. Because you're not making $18,000 a month. We need to look at your personal budget and see how can we refine that? What do we have to do?
Yeah, I had a general manager that worked for me one time that was making 6 figures, and he told me I just wasn't paying him enough. And I said, well, you're taking more out of it than we're getting out of it. We got all the risk and the bank debt. I said, but maybe you don't need a Suburban and a boat and 2 jet skis and a house and a girlfriend and all of the expenses that you have, maybe what you need to do is have a little spending discipline before you sign another note. Because as he said, as we tried to point out, you don't own any of these things. You're just borrowing money against them so that you have access to use them. And that's a tough thing, because a lot of people look at equipment acquisition and things like that, and they'll lease equipment and things and not realize, whether it's a capital or an operating lease, that these costs are going to be paid over time. And when you're financing that equipment, you better make sure that the lifespan of the equipment and the lifespan of the lease go together, because when they die, you may still have time left on that capital lease.
I even had one of my staff accountants, who's an accountant, come to me one time and say, Patrick, I just want to find out what our raises are going to be at year end. And it was like now in March.
So I can spend it.
And I said, well, you're assuming you're going to be here at year end. So, but if you are, why? And he said, well, because of our bills. And I said, well, yeah, but you got it backwards. You need to budget your bills on what you make, not budget what you make on what your bills are.
Right. So we got a simple example up right now on a business with $100,000 of revenue. So can you kind of walk through this? And this kind of aligns with that. How do you pay yourself? If you want to pay yourself 5,000 and your profit's 3,000, it's kind of tough to do, isn't it?
Yes. So as everybody knows, the profit margin on a restaurant from a net income perspective is tight. Then prior to COVID, and Stan, you might even have more updated statistics than I do, but 3 or 4 years ago, the national average of net profit for a restaurant, not net cash flow, net profit, and I'll tell you the difference in a second, was about 10%. 10% net was what it was, 5 years ago. Now, I have clients who net as much as 12 to 20% net profit, and they are very good restaurateurs, and they really know what they're doing, and they watch their costs religiously. But based on this example we have right here, we're looking at cost of goods sold budgeted at 30% and labor budget at 30%, or in reality, what your goal should be. Then we use an overhead cost number of 30,000 or another 30% or so, which puts us at 90%. So technically we'd be at the 10%, but then we have to consider the debt service we might have on the restaurant if we have debt. Then we have to consider any fixed assets we might have had to subtract to really and truly leave us with a $3,000 profit.
Now, a real profit.
I'm sorry?
A real profit.
Right. Real. Now that's the cash flow number. That the profit would be 8,000. I'm sorry. The profit would be 10,000 on the P&L. The cash flow would be 3,000. So I know that's painting a pretty gloom picture. It doesn't have to be that way, but in reality, that's what people need to watch for.
Well, we talked again too about the concept of pushing revenue above break even, because typically those direct costs, those fixed costs and cost of goods are going to be, the direct costs are going to be minimal, growing higher, but your fixed costs are going to flatten out as well. So it's really that variable cost dealing with food costs, maybe some additional linen, maybe some additional waste cost and all that, and trying to say, take this $100,000 business with this model. If all of a sudden they could do 200,000, they might generate another $25,000 or $30,000 when this would be a very different looking P&L.
And I'll tell you another thing we've done a lot of in the past 60 days, and I'm sure everybody knows, and if you don't know, you look at your vendor invoices, the vendor's pricing has went up in the past 60 to 90 days. We have had to, I've done and suggested theoretical food costs be recalculated. We just did it on my restaurant and learned some very, very important things where we had to adjust some things on our menu pricing without being crazy. One of the things you don't want to do is say, well, we're not making money, let's raise the prices.
Right.
Well, you look at that, that's going to come back and haunt you.
You look at that 80-20 rule, but typically when you're talking to a broadline distributor, the information they're giving you on a velocity report is to get your eyes to focus on those 20% of those items that you spend 80% of your money on. But unfortunately, if you're not converting that to a menu price adjustment, you as I told you guys that story early on about, we sold an item for $19.95 that cost us $23.95. It just doesn't work. We're never going to make any money on that. Even if we sell 100 more of them, we'll just keep losing more money. But understanding that cost and understanding really looking at those vendor invoices and comparing those from week to week, especially on those items that you purchase a lot of. In one of our restaurants, we purchased a lot of baby back ribs, 30,000 pounds a week. And if those swung 50 to 75 cents a week, that could be the difference in whether we made a profit or whether we lost money that month, that week.
And I think one of the things worth noting on this example page too is somebody might be looking at this and saying, well, I can't live off of that $3,000. If you've gone through the budgeting process, you're actually, your salary that you're paying yourself is in that labor dollar already. Right. So not that you want to be super aggressive with your own salary, but if you've budgeted for a reasonable salary for yourself, you've actually already gotten paid under that direct cost line, and there's still $3,000 profit left at the end of the month.
That's a great point. And one of the things too, Patrick, I know you've seen this, restaurant people, we're nice. We like to give stuff away. We like to buy drinks for our friends. We like to give them expensive bottles of wine and things like that. But if you don't calculate that into this type of revenue model, so you understand it, I was working with one of our members a couple of years ago, and he kept explaining to me, he says, we're doing really great volume. And then I realized, I said, well, I've had dinner with you twice, and both nights we drank wine that cost $150 a bottle. So if all of a sudden you've got a $9,000 a month wine habit at cost, what did that cost you in lost opportunity, right?
Yes. And also you should always charge your friends. They're coming to help you, so they should pay.
Absolutely. You know, I used to tell our managers in our restaurants, I don't care what you comp and who you comp, but I need you to write down why we comped them. Okay. A good friend, great customer is not the reason.
And typically, just so you guys know, comps, reasonable comps that we look at in benchmark comps are typically 2% or less. If it gets up to 3, 4, 5%, you're competent. That you're giving away half of your profit right there.
And you got to remember too, that when you give that stuff away, you got to owe the sales tax on it.
Correct. Which is use tax, which could be a whole nother seminar also. But I want to mention one more thing, and Brian, I think could chime in on this too. You mentioned break even, Stan. And one of the first things I do when I have a client that opens a restaurant, or somebody comes to me and I'm discussing with them, is I ask them, if they're already operating, what is your break even sales number? And so some people know it and they're pretty fluent in it. I say, okay, so, because I'm trying to address why they're not making money or why they could make more, either way. And the break even is key, because if I know what the break even is on pretty much every client I work for, pretty much, okay, they fluctuate some, but so if I know that your break even for your restaurant for this week is, and you can we're going to start making money when you do over 30,000 a week or 50,000 a week or whatever it is, and I know sales already today are 35,000, we're going to have a great week. Next week the cash flow is going to be great. I know what the break even is in my restaurant. So I get sales every day in an email. And when I look at them, I get sales for about 5 or 6 of my clients. And with that, I can almost tell next week we're going to have cash because we're exceeding our break even per week.
Yeah. If you're operating against that break even like that, it's not going to be a surprise that you made money. You know, you made money because you're operating again with that same operating discipline that you do in everything that it takes to run that business. If you're not doing these things, then your business is running you. And that's not a great way to operate like this, because you'll just spend a lot more time and you haven't figured out the basic things. When people tell me they want to open a restaurant or a bar, I tell them that they want to get in the restaurant or bar business, right? It's not the idea of standing behind the bar at Cheers and knowing everybody's name and buying drinks for your friends and hosting a party every night. It's a business. And like any other business, whether it's a dry cleaner or a auto parts store or anything else, you can lose a lot of money in the restaurant business if you don't know what you're doing.
Yes, definitely.
I think we've got one more slide on there. Any questions, anything that we can answer about this? The whole idea with putting this series together is to try to provide information. None of us have all the answers, and all of us have gray hair from doing this, whether our hairs change colors or not. We just don't know it yet. Some of us have pulled our hair out doing this. So it's a challenge, but understanding how to operate a business. We want to talk just briefly too, Patrick. We mentioned the Restaurant Revitalization Fund grants. We haven't seen all the rules yet, but we know that it's very robust and it's a little more expansive than PPP. And that's going to be coming down. We think there'll be a run on the bank, quite frankly, because the industry suffered over $250 billion of losses since through January of this year. So 28 billion, while it's great, it's not enough money. Now, another good thing is for our smaller businesses, our women-owned businesses, our veteran-owned businesses, some of our minority-owned businesses, there's 5 billion of that set aside for them as well. So that's something to keep your eye on. And we do expect that portal is going to open up in the next probably week to 10 days.
And that's something that definitely, like Brian mentioned earlier, and he could expand on it also. When you get PPP funds, you need to really budget to use it correctly. We did a lot of budgets like that for people last year on using it and making sure you get forgiveness. Because I think the last thing you want is to take a potential grant and turn it into a loan. Nobody wants to do that. And I would say that Brian is an expert with working with me on us working through the forgiveness for his businesses because they're complex and we are becoming very trained experts at forgiveness. And I've done probably between the first and second round, 160 PPP loans at least. And so you really need to use the funds wisely and don't just spend it, even if you're going to cover forgiveness, because we don't know where we're going to be for sure in August or in September right now, really and truly, I think most people, if you talk to them and they answered honestly, they would have never thought we even had COVID existing right now. It was supposed to be a 90-day thing, right? 3 months. It's going to be
Patrick, when I
over.
went back to our notes with the first meeting we had with the governor on March 9th last year, March 10th last year, the notes were it's going to be 60 days tops. By 90 days, we'll be back to normal. And I reminded him of that this week when we were talking about the restriction and getting rid of the capacity number, the percentage of capacity. It's always out there, but this is the great unknown. But the one thing I remind our congressmen, what we've reminded the White House, what we've reminded our legislators as they look to spend the American Rescue Plan money. This happened through no fault of our own. This was not anything our industry did. We're not reacting to a natural disaster where the water comes in, the wind comes in, the power goes off, and then 5-7 days later, we're back to operating again. This has been much longer. It really has been a case of the strong surviving in this. And I think we're going to come out of this with better operators. We're going to come out with operators who understand how to make a profit, and they're going to look at their business with a whole lot more discipline. And I use that word a lot, but it really is the difference between whether you're successful or whether you're just getting by in this business, because that's the key. When you have people that work for you, when you have people that rely on you, that used to bother me so much. We had 3,100 folks that work for our company. And every day, that's what I looked at it through the prism of, can I make sure that I take care of these 3,100 people that work for us? And that's just kind of the nature of the hospitality industry. We really are all in this together. None of us can do it alone. So be happy to take any questions. You can use the chat feature. You can unmute if you like. You can ask any questions. But otherwise, I'll wrap to Brian and Patrick. You can come up next and put the final point on it. Brian, you got anything you want to add?
I would just highly suggest to all the operators out there, navigating PPP and applying for the grant is a lot of times well above the skill level of a typical restaurateur, well above my own skill level. So having a partner like Patrick to help navigate these things, because they are large amounts of money, has been crucial to our success over the last year. And I think because really understanding the nuances of the money you're either borrowing that could convert to a grant, even paying yourself, there's a nuance to that. And the last thing you want to do is pay yourself with PPP to only find out that you paid yourself with a loan. Because then you're going to have to pay your own paycheck back over the next 18 months or 5 years. So finding a partner to help you navigate these very complex issues, I would highly recommend it.
Yeah, it's not a shame to ask for help. And you can always contact us at the LRA. We've got a group of professionals we can always refer you to, people like Patrick that can, at the very least, take a call from you and tell you what you don't know already or what you need to know. And then you can decide whether you're going to partner with them to try to help you navigate some of these things, because that's their area of expertise. And as we saw with the first round of PPP loans, what those original loans look like and the rules and how they were going to be treated, and what it became when we passed the CARES Act flexibility were very, very different. And then the last round of stimulus even expanded to C6s and other organizations that might not have been included before. So, Patrick, I want to thank you for doing this for us. I'm going to give you the last word.
I just want to thank everybody for joining us. I hope we added some value. Some of it may be elementary to you, some of it may not. It's what I do every day. I always appreciate working with restaurateurs. Brian's a hell of a restaurateur himself, him and his partner Emery. They make my work fun.
Well, that's
And
good.
accounting is usually not fun.
Well,
So it's fun.
the good news about that is, I spent the bulk of my career working as we were a franchisee of Ruth's Chris Steakhouse, and Miss Ruth reminded me of a couple of things that I've never forgotten. Number one, cash is king. And if you have cash, you always get to be the king. And number two, which I've never forgotten, life is too short to drink well liquor or house wine. So with that, we'll put a wrap on it. We want to thank Patrick for putting this, sponsoring this series for us. Chef Brian Landry for joining us and sharing his insight, because that's what makes this community. That's what the LRA is all about, bringing in disparate voices, different thoughts, how we can do this better, how we can work to have a more vibrant and resilient industry. And we're always here. You can check us out at LRA.org or give us a call at 504-454-2277. If you have a message you want to send to us, drop it to communications@LRA.org, communications@LRA.org. Until we meet again, thank you so much for joining us. And gentlemen, thanks for the presentation.